Introduction. May 22nd, 2010 is now known as Bitcoin Pizza Day. The reason is that a man named Laszlo Hanyecz, a programmer by profession, ordered 2 pizzas from Papa John's. This purchase was one of the earliest transactions in Bitcoin history, but that is not the reason the event is called Bitcoin Pizza Day. Hanyecz could have paid for the pizza in ordinary fiat currency, US dollars. Instead, he chose to spend nearly 10,000 bitcoins on the order, each bitcoin worth less than a cent at that time. The transaction probably felt progressive back then, which it was, because it was an entrance into a new world of transactions using digital money. But the story also highlights the exponential growth of Bitcoin and other cryptocurrencies in general. By November 10th, 2021, when Bitcoin reached an all-time high, each Bitcoin was worth roughly $68,000. On that day, had Hanyecz instead held onto those same Bitcoins that he spent on 2 pizzas about a decade ago, the coins would have been worth a whopping $680 million. That is why that day is called Bitcoin Pizza Day. This story, and many others, both public and private, can give you an idea about the craze behind digital currencies over the past decade. Such stories illustrate how it was possible for many people to have made fortunes with relatively puny investments over the past decade. For example, a software engineer from India named Metakovan, who now lives in Singapore, spent only $5,000 on crypto investments when he was a student back in the early 2010s. Today, he is a billionaire, made famous in the media by a $69 million purchase of digital art. He is still holding 99% of his wealth in digital currencies because he believes that cryptocurrencies still have lots of upside. But there is also a dark side. Other stories have unmasked the financial and emotional devastation that crypto investments have wreaked on investors. One observer calls cryptocurrency trading the crack cocaine of gambling. One can see why. Jake, a pseudonym used for a BBC article, lost almost all his money in a matter of 20 minutes. An addict of crypto trading, he would be glued to his computer screen for months as he watched his portfolio grow exponentially. Then the market suddenly tanked at the end of the 2018 bull market, and he was forced to liquidate his positions to salvage whatever little scraps he could. Subsequently, he sought addiction therapy. Many other people must have done the same, although their stories are not highlighted in the media. Since that time, cryptocurrencies have soared up and down many times like a roller coaster, a wild ride indeed. Periodically, the entire space can seem like a short squeeze, sudden astronomical price increases that make you experience what investors called FOMO, fear of missing out. Hordes of people rush in, hoping to get rich quickly before it is too late, just before the tide turns and they flood out. World-renowned investing guru, Warren Buffett, arguably the most successful investor in history, is famously critical of Bitcoin and the crypto space in general. But his methodical approach of studying business fundamentals like balance sheets and cash flow and being content with slow but steady growth can seem outdated when crypto prices zoom upward. But when crypto prices crash, he seems prescient and brilliant. Understanding Bitcoin and other cryptocurrencies can seem like an overwhelming task. The space is filled with jargon that can be as perplexing as a foreign language. Thus, for the average person, it is highly discouraging and off-putting to navigate through crypto news or even to watch a YouTube video about DeFi or NFTs. So they just quit trying. Cryptocurrencies are not even taught in most universities, not even to finance students. Without having a basic understanding of cryptocurrencies and how they work, how can someone make a good investment decision in regard to such assets? An uninformed person that invests in cryptocurrencies shoots randomly, blindly following whatever pops up on YouTube. You can get lucky once in a while, but how long will that luck last? Investing in cryptocurrencies without any knowledge is a recipe for financial disaster. It is like a child playing near a pothole. This book is not financial advice. It is not even meant to teach you strategies to invest. Nothing in it should be construed as such. The only purpose of this short book is to provide you with basic knowledge of Bitcoin and cryptocurrencies in general, so that you have the tools to navigate through the space if you decide to read about it in the paper, research about it, watch a video on YouTube, or study it in other ways for other purposes. It is short and meant to be easy to read and easy to understand, because most people simply do not have the opportunity to try to navigate through long cryptocurrency texts. They do not have the time to abandon other parts of their lives and pore over complicated information. For your ease, the book is in audio format, Kindle and paperback. After you finish the book, please leave a review and let me know what cryptocurrencies you have your eyes on. Chapter 1: Cryptocurrencies, Altcoins, and Blockchain Technology. What is all of this? Cryptocurrencies are digital currencies that are secured through cryptographic methods. Let us break that down. They are currencies that have no physical manifestation, like in the form of bills and coins. They exist only in the digital realm and can be viewed and transacted on only digitally, as on a computer or phone. In other words, they exist in thin air. They are highly secure through cryptographic methods. Cryptography is the science of securing information. In the context of cryptocurrencies, this means that cryptocurrencies and related transactions are highly secure from theft and something called double spending. As the term suggests, double spending is basically spending the exact same cryptocurrency twice, as if the first transaction did not occur. It is like being able to spend the exact same dollar bills twice. Bitcoin, which was introduced in 2009, is the first and most prominent cryptocurrency. It has the first mover advantage, allowing it to seize most of the media attention. By December 2021, it made up more than 1/3 of the entire crypto market. And for much of its history, Bitcoin alone had more market share than all other cryptocurrencies combined. Apart from Bitcoin, every other cryptocurrency is known as an altcoin, short for alternative coin, because they are all alternatives to Bitcoin. The cryptocurrency space is still in its infancy, only about 13 years old. All sorts of new and creative crypto projects are being created, seeking to provide different digital solutions and innovations using blockchain technology for real-world use cases. How many cryptocurrencies are there? Approximately 15,000. As such, it is difficult to keep abreast of all the projects as they differ in size, scope, and purpose. Thus, finding that one coin that can give you 100 times the return is harder than trying to find a needle in a haystack. It can be extremely time-consuming, perhaps a life goal or obsession, as it already is for some people. But for those people, such a journey is worth it, because if they find and invest in that one lucrative coin, they can make a fortune that they and their heirs can enjoy for generations. A large number of cryptocurrencies will probably fail, as many have already. But if cryptocurrencies are not just a fad, there will certainly be massive winners. Finding those winners require not only good researching skills, but also understanding the basics of cryptocurrencies and blockchain technology. This book seeks to provide you with that rudimentary understanding. Why would people buy cryptocurrencies? In this section, let us look at some common reasons why people buy cryptocurrencies. First, they buy them as a hedge against inflation. Let us break that down. As governments around the world continue to print large amounts of fiat money, especially the US government printing US dollars, the value of fiat money decreases over time. It is basic economics. The higher the supply, the lower the value. As such, the fiat money that you save in the bank declines in value over time, even if you have not withdrawn any amount of it. Simply holding onto it is a kind of loss. This trend has accelerated due to the COVID pandemic. In an effort to prevent people from starving on the streets, the US government printed trillions of dollars for stimulus packages, further diminishing each dollar's value. Cryptocurrencies protect against such inflation, such debasement of wealth, because a cryptocurrency's supply cannot be increased at will, the way US dollars, for instance, can. In the case of Bitcoin, for example, the supply is not allowed to exceed a predetermined amount, as will be explained in the next chapter. No government can change this policy and issue more than the predetermined amounts. Second, people buy cryptocurrencies because they do not trust the dollar, nor do they trust centralized finance and financial institutions like government policy and banks. Keep in mind that Bitcoin was created during the financial crisis in 2008, when trust in banks and central monetary policy was at an all-time low. At that time and after, protesters and cynics claimed that the financial system was a scam, that it was rigged in favor of the rich, because of how the government bailed out Wall Street companies and too big to fail banks at the expense of average citizens, the millions of people who lost their jobs and homes. Thus, the crypto space is seen as an alternative financial system, one that is not rigged in favor of the rich, one that is not in the hands of the rich. Rather, it is seen as a way to level the playing field. Third, people purchase cryptocurrencies because they want to get rich. Cryptocurrency price movements are extreme, usually much more extreme than stock market prices. So, people hope to invest at the right time, just when crypto prices explode. But these hopes have proven to be a double-edged sword. As indicated in the introduction, the media is teeming with stories of people who have made fortunes through crypto investments. The reverse is also true. The media is also full of stories of people who have lost large sums of money due to crypto investments. What is blockchain technology? Blockchain technology actually predates Bitcoin by more than a decade. However, Bitcoin's emergence brought the technology into prominence and has made the two seem synonymous, even though they're not. Because cryptocurrencies exist on blockchains, it is important to have at least a basic understanding of blockchain technology. At its core, blockchain technology is a network of computers that preserves and secures information. Each computer is called a node. Each node has a copy of the information. If one node gets compromised, either by getting hacked or getting shut down, the information is still preserved and secure through the other nodes. In other words, the nodes back each other up the way fellow soldiers do. Typically, the nodes are spread out across countries and continents, making it even less likely that the network gets compromised as a whole. For example, as of January 15th, 2022, Bitcoin had more than 13,000 nodes spread out throughout the world. Thus, no single country can simply shut the network down as a whole, even if a few individual nodes get compromised. To shut down Bitcoin or manipulate the network would require cooperation between almost every country or more than half of the nodes on the network. Such cooperation is frankly highly unlikely, if not impossible, given that governments are unable to unanimously agree on any issue today, let alone on cryptocurrencies. As such, blockchain technology ensures greater security of information compared to traditional systems because it does not rely on a single point, computer, or server. There are different types of blockchains, like public and private blockchains. Prominent corporations like IBM, Microsoft, and Walmart use private blockchains to store data more effectively or to improve their supply chains. These private blockchains are centralized, controlled by corporations, and the public cannot access them. Cryptocurrency blockchains, on the other hand, are different and have unique characteristics. First, they are public blockchains, meaning that anyone with an internet connection can access them. Second, they provide a full and accurate record of all transactions on the network, dating back to the very first transaction. It is basically an extensive public ledger, a complete history that anyone can access. Beyond this, cryptocurrency blockchains have evolved to include smart contracts, which will be explained in the next chapter. Third, blockchain technology is decentralized. Specifically, blockchains are peer-to-peer, meaning that all nodes on the network are equal. No one actor, central authority, controls or dominates the network, unless they control 51% of it, which is still highly unlikely, if not impossible. It is thus a network of equality, in which no government or corporation can act arbitrarily or in a way that bends the rules. As mentioned above, this idea is especially appealing to some people in the context of the financial crisis in 2008, when the government was seen as manipulative and arbitrary, as bending the rules in favor of the ultra-rich. Cryptocurrency blockchains are seen as evading that kind of manipulation. Although public blockchains share the three characteristics mentioned above, it is important to note that different cryptocurrency projects have different ways of using blockchain technology. Ethereum uses it in a different way than Bitcoin, Bitcoin in a different way than Solana, Solana in a different way than Polkadot, Polkadot in a different way than Litecoin, and on and on. The point is that blockchain technology is a creative and evolving space, one full of diversity, as newer projects seek to harness its advantages in newer and different ways. In subsequent chapters, this idea will become more apparent. Chapter 2: The King of Cryptocurrencies, Bitcoin. Bitcoin is the king of cryptocurrencies. It is the largest and most prominent cryptocurrency. When people talk about cryptocurrencies, they usually have Bitcoin in mind. Some people may even mistakenly think of the two terms interchangeably. It is an understatement to point out that Bitcoin has the largest market capitalization in the cryptocurrency space. A coin's market cap refers to the total value of all its coins put together. In fact, as it has done throughout its entire history, Bitcoin dwarfs every other cryptocurrency in size and prominence by a large margin. As of January 2021, Bitcoin's market cap is larger than the market caps of the next 10 cryptocurrencies combined. Even compared to the stock market, Bitcoin is larger than almost all publicly traded companies in the world. As of December 2021, only Apple, Microsoft, Alphabet, Saudi Aramco, Amazon, and Tesla had higher market caps than Bitcoin. What is Bitcoin? Bitcoin is primarily a digital currency, a currency alternative to fiats like the US dollar. It has no physical representation. It exists only on the blockchain and is commonly used as a store of value, as a hedge against inflation, for transactions, and for investments. A person's bitcoins are protected through cryptographic methods. Satoshi Nakamoto is the founder of Bitcoin, but that is all we know about it. He, if it is even proper to use that pronoun, has never even come forward to the public. Nobody even knows if Satoshi is a person or a group of persons. The white paper, the Bitcoin Protocol, was issued in 2008, detailing how Bitcoin would work on the blockchain and the rules that would govern it. Many coins have white papers, which can be thought of as a protocol, a founding document that outlines a strict set of rules for how a cryptocurrency is going to function on the blockchain. As mentioned already, Bitcoin is the first cryptocurrency to harness the advantages of blockchain technology. The first Bitcoins were issued in 2009. The initial price for each Bitcoin was less than a cent. However, as of December 2021, each Bitcoin was hovering around $50,000, illustrating the exponential growth of the crypto space in general and why there is such a craze about it. It has not always been a smooth ride, though. As mentioned before, Bitcoin's ups and downs are wild, with many people becoming financially free or bankrupt. As implied before, Bitcoin was meant to be an alternative form of finance, free of centralized control, like from the government or a corporation. No intermediary, like a bank or government official, is involved in any part of transactions. The only entities involved in transactions are the ones engaged in them. That is it. Only the contracting parties are involved. Bitcoin is also meant to be a hedge against inflation, a protection from inflation, as implied in the previous chapter. In order to achieve this in practical terms, the white paper stipulates that there will only ever be 21 million Bitcoins in circulation. In other words, no government or central authority can devalue Bitcoin by issuing an endless supply of it, as regularly happens with the US dollar. Currently, there are 18 million Bitcoins in circulation, many of which have been lost due to a myriad of reasons, something the white paper did not seem to have foreseen. As various media reports show, some people forgot their passwords and have lost Bitcoins because they no longer have access to their digital wallets. Other people died, not having passed their Bitcoins to their heirs. For such reasons, some Bitcoins are forever lost from active circulation, meaning that there will never actually be 21 million Bitcoins in active circulation. Fewer Bitcoins in active circulation would naturally indicate that the remaining Bitcoins would have even more value. Perhaps the most illustrative example of this circumstance is of Stephen Thomas, a programmer in San Francisco, who had approximately $240 million worth of Bitcoins as of January 2021 locked in his digital wallet. Years before, he wrote the password to his account down on a piece of paper, but lost it with no way to recover it. As of May 2021, media reports still claimed that he had 2 guesses left to get access to his account. If those 2 attempts are unsuccessful, he will lose all his Bitcoins permanently. As mentioned before, 18 million Bitcoins are in circulation. The remaining approximately 3 million will be mined digitally. Bitcoin mining will be covered soon. How do Bitcoin transactions get recorded on the blockchain? Each time a transaction involving Bitcoin occurs, it gets recorded in the latest block on the Bitcoin blockchain. You can think of a block as simply a page in Bitcoin's accounting record. A full block usually contains approximately 2,000 to 3,000 transactions, equaling approximately 1 MB in size. Once a block is full, all the transactions in the block are verified, and the block is added to the chain of previous blocks, hence the term blockchain. Thus, the Bitcoin blockchain is actually a complete history of all transactions that have occurred on the network ever since the very first transaction on it. Then, a new block is created for newer transactions, and the process is repeated. The list of transactions on the blockchain is publicly available. It is commonly referred to as a ledger, like an accounting ledger, and each node on the network possesses a copy of the ledger. It cannot be tampered with. As mentioned before, if anyone tries to tamper with the ledger on a node, other nodes on the network still possess the correct ledger, rendering the attempt futile. What is Bitcoin mining? What is the proof of work method? To put it simply, Bitcoin mining is essentially the process of verifying a new block of transactions in exchange for a reward of newly minted Bitcoins. To elaborate, and as mentioned in the previous section, whenever a new block of transactions is created, it needs to be verified before it is added to the chain of blocks. This is where Bitcoin mining and hence the proof of work method comes into place. The proof of work method is a way of verifying blocks of transactions. There are other methods as well, like proof of stake, proof of authority, that other cryptocurrency blockchains use, and these will be explored in subsequent chapters. The proof of work method with respect to Bitcoin works as follows. Essentially, when a new block of transactions needs to be verified, nodes from across the network compete with one another to accomplish this goal. In order to do this, nodes are required to solve an extremely complex mathematical problem. These mathematical problems are part of the cryptographic process of securing data and require vast amounts of computing power. The complexity of the math problems is beyond the capabilities of a single human being. Whichever node successfully solves the problem first wins. After transactions have been verified, the winning node's completed block is accepted and officially added to the chain of blocks in exchange for a reward. When Bitcoin was first created, a single ordinary desktop was sufficient to verify a block of transactions. However, the math problems have been getting tougher as the network has been growing over the years. Now, many more nodes are in competition with each other to solve the problems and verify transactions first. As such, much more computing power is required to verify these transactions quickly. The winning node gets the reward of newly minted Bitcoins. The rewards for each mined block are halved approximately every 4 years, as the Bitcoin protocol envisioned. This event is called the halving and is a prominent event in the crypto community. In 2009, the reward was 50 Bitcoins per block. Since May 2020, the reward has been 6.25, and by 2024 or 2025, the reward should be approximately 3.13 Bitcoins. If you want to do Bitcoin mining, you need to buy additional software and tools that drastically increase your computing power and speed compared with the average computer. These tools are expensive and can cost more than $10,000. You can also create or join a Bitcoin mining pool, which is essentially joining a group of computers. These computers combine their computing power and speed, and the rewards that they earn are split between participants. Another option is to invest in Bitcoin mining stocks like Riot Blockchain and Marathon Digital Holdings. These Bitcoin mining companies build large-scale computing infrastructure and mine Bitcoins. From early 2020 to early 2021, shareholders have been rewarded with explosive gains. A $1,000 investment in Riot in April 2020 yielded approximately $70,000 by February 2021. A similar investment in Mara yielded $75,000 by November 2021. These gains have significantly outpaced an equivalent investment in Bitcoin itself over the same time period. Bitcoin as legal tender. What is legal tender? Legal tender essentially means that a country has accepted a currency as an officially recognized means of doing commerce. This means that businesses are obligated to accept the currency, and a person has the right to pay off debts, pay taxes, and fulfill contracts with that currency. In other words, people would be allowed to settle their financial obligations in Bitcoin if Bitcoin were to become legal tender. If cryptocurrencies like Bitcoin are actually going to replace or compete with fiat currencies in the future, as a primary means of commerce, as a founder of Bitcoin himself may have envisioned, they need to become legal tender. The average person needs to be able to use it on a day-to-day basis for day-to-day tasks like buying groceries, paying utility bills, and similar expenses. This has not happened yet in any country except in El Salvador. On September 7, 2021, El Salvador became the first country in the world to accept Bitcoin as legal tender. Beyond this, a massive developmental project called the Bitcoin Beach Initiative is being implemented in the country in a small coastal town called El Zont. A massive anonymous donation of Bitcoin dedicated to this project is being used to fund these developmental initiatives. Locals are using Bitcoin for a variety of everyday transactions, like buying groceries, accepting salaries, and paying utility bills. Such initiatives in El Salvador are a major milestone in the cryptocurrency space's history. What was once a dream and then a fringe idea gained growing acceptance and has now become the legal tender of a sovereign state. It begs the question, which country is next? Is this just the first step toward worldwide adoption of cryptocurrencies as legal tender in almost every country? These are questions that indicate the real possibility of such an occurrence, even if they occur decades from now. Chapter 3: The Queen of Cryptocurrencies, Ethereum. After Bitcoin, Ethereum is the second largest cryptocurrency by market cap, although by December 2021, it had not even reached 40% of Bitcoin's size. Once again, this illustrates the dominance of Bitcoin in the cryptocurrency space. However, Ethereum is a beastly creature in its own right. Its price has been growing much faster than Bitcoin's since the market crash in 2020. An investment in Ethereum has been several times more lucrative than an identical investment in Bitcoin during that same time frame. A glance at Ethereum's 2-year chart compared with Bitcoin's 2-year chart would make this claim obvious. Many people are speculating that because of Ethereum's far greater number of real-world use cases compared with Bitcoin's, as will be shown later, Ethereum's market cap will continue to outpace Bitcoin's growth for the foreseeable future until Ethereum eventually surpasses Bitcoin. Perhaps this could happen within the next decade or even sooner. As such, some people believe that Ethereum will eventually replace Bitcoin as the leader of the cryptocurrency space. Then, there will be no need to call Ethereum an altcoin anymore. Many people perhaps do not know the distinction between Ethereum and Ether, so it is important to make that distinction clear before continuing on. Ethereum is essentially a platform for the Ethereum network and programs. Ether, on the other hand, is the Ethereum network's native cryptocurrency. It has myriad uses: investments, store of value to combat inflation, Ethereum programs, and commerce within and outside of the platform. Ethereum is clearly making inroads into mainstream finance. Large banks like Goldman Sachs and Morgan Stanley are now offering select clients exposure to Ether, just as they have provided exposure to Bitcoin. This chapter will provide a foundational understanding of Ethereum and its most prominent aspects like NFTs and DeFi. These terms will be explained later in this chapter. With the knowledge contained herein, you will not be like a lost sheep anymore when you try to read or watch information about Ethereum. You will be able to follow along, even if you have to do additional research at times to keep up. With that said, Ethereum is conceptually much broader than Bitcoin, and it is constantly growing and evolving, as will be shown in this chapter and the next. As such, to gain a deeper understanding of Ethereum will require much more time and effort, but at least this chapter will give you the basic tools. If you are interested to delve deeper into Ethereum, its website, ethereum.org, is the ideal place to begin with. In addition, plenty of helpful tutorials are also available on YouTube that provide a comprehensive understanding of every aspect of the platform. What is Ethereum? Let us begin with the basics. Ethereum was founded in 2013 by Vitalik Buterin. The white paper, the founding document, is available on Ethereum's website. Ether began to trade in 2015, 6 years after Bitcoin. As such, Bitcoin had the first mover advantage by approximately 6 years. But as mentioned earlier, Ethereum is at times fast closing the gap in terms of market capitalization. As its website claims, Ethereum builds on the idea of Bitcoin, which is the idea of a digital currency. In other words, while Ethereum is primarily digital money, Ethereum is also that, but much more. So, what is Ethereum? Ethereum is essentially a vast, decentralized blockchain network that hosts a variety of computer programs, called decentralized applications, dApps for short. The term dApps is commonly used in crypto media. These dApps are essentially apps, a term that most people would be familiar with. Ethereum is thus a kind of mini internet, a marketplace, a kind of virtual mall where people create and use a whole suite of dApps for all kinds of purposes like gaming, finance, and insurance. That is why Ethereum's founders refer to it as a programmable blockchain. Developers use a programming language called Solidity to write code and create dApps. When reading about the Ethereum blockchain, one comes across the term smart contracts. Smart contracts is just a more complicated term for these dApps. The question that comes to mind is, how are these dApps different from apps that you might find on your phone, for example? The main difference is that dApps on the blockchain function without any human oversight or centralized control. They are self-automated and self-executing, as will be explained shortly. The Ethereum website gives a simple example to illustrate the concept. Smart contracts are like vending machines. Put coins into a vending slot, and the machine will automatically do the work for you. It will figure out your selection, calculate the amount on its own, and then use a bunch of levers to dispense a snack. The functioning is automatic, and it has no human intervention at all, except for you making your initial selection of a snack. Thus, when you use an Ethereum application, you are basically using a program that is as automatic and self-executing as a vending machine. You can trust that no human oversight or intervention is possible. The rules for the smart contract cannot be altered or tampered with, such as by a government or corporate official. In other words, the code is permanent and unalterable once the dApp is uploaded. For example, if someone executes a trade on a decentralized exchange, the trade cannot be reversed by any human oversight or tampered with in any way. Market makers cannot bend the rules and halt trading whenever they wish, the way Robinhood did during the GameStop short squeeze in 2021. Thus, dApps give new meaning to the freedom of the individual in a variety of realms. dApps will be explained in greater detail in the section below. Just as with Bitcoin, the individual is freer from centralized control, be it government or corporate. More on smart contracts. The Ethereum website sorts its smart contract platform into three categories: decentralized finance, DeFi, non-fungible tokens, NFTs, and decentralized autonomous organizations, DAOs. An understanding of these three categories gives one a basic framework for what Ethereum offers, an appreciation of its potential, and how it significantly builds on Bitcoin's initial innovation of a digital currency using blockchain technology. This section will provide an overview of each of the categories mentioned above. The first category is called decentralized finance, also known by the popular abbreviation DeFi. DeFi is the rage today, perhaps the most watched sector of cryptocurrencies. If you watch cryptocurrency videos on YouTube regularly or follow a crypto-related publication, chances are that you have heard about DeFi plenty of times. Ethereum's DeFi is a massive platform for dApps that provide financial services. Through these dApps, you can invest, borrow, lend, collect interest, and more. Billions of dollars flow through the platform. It is clearly intended to be a complete financial system, one that may even rival Wall Street one day in terms of size and scope. Now that is a bold statement. In addition, through DeFi, you can even mint new cryptocurrencies. These cryptocurrencies operate on the Ethereum network and are called ERC20 tokens, meaning that they depend on the Ethereum network to function and adhere to certain standard rules in their code. Some of these tokens, like Tether and Chainlink, have even developed into behemoths themselves, becoming some of the largest cryptocurrencies by market cap. There are many other ERC20 tokens soaring in market cap, and the growth of these coins contributes to the prominence and indispensability of the Ethereum platform as a gargantuan financial hub. But the main difference between mainstream finance and DeFi is that DeFi has no market makers, no intermediaries, nobody to oversee a transaction or take a slice from you. The system is self-executing and always follows the same rules embedded in code. Thus, as mentioned in the last section, nobody can take arbitrary action and freeze trading, as happened during the GameStop short squeeze in early 2021. Actions that tremendously benefit the ultra-rich at the expense of everyone else. Also, unlike in traditional finance, markets are always open in DeFi, and transactions are always final and irreversible. As opposed to traditional banks and financial institutions, with DeFi, you do not even have to provide your personal data. or open a bank account. Thus, privacy in finance is taking on a new meaning. All you need to do is open an Ethereum wallet and get some Ether in it. That is all. The benefit with this is huge for many people. Many millions of people across the world who do not have access to a bank account or who are reluctant to provide their personal data to banks can use these services without giving up their personal identity. More on this in Chapter 5. Apart from these benefits, there are other revolutionary benefits as well that can significantly improve day-to-day commerce for everyone. People, corporations, and even governments, whether it be moving minuscule or large funds around. Because DeFi is automated, the technology ensures that transactions are quicker, more efficient, and cheaper. Money can be sent around the world within seconds, if not instantly, unlike in traditional finance where this can take days. For all the above reasons, DeFi is a promising and thriving space. It has gotten investors excited about future prospects for growth, as evidenced by the rocketing price of Ethereum over the past 1.5 years. As mentioned, billions of dollars flow through these dApps on DeFi. From 2019 to 2021 alone, the amount of money flowing through these dApps has increased from approximately $1 billion to about $80 billion, representing an 80-fold increase in just 2 years. As more people use Ethereum, it is easy to imagine that this technology will continue to become much larger. A more viable, alternative global financial system in the next decade. Non-fungible tokens, NFTs. Ethereum has the largest platform for non-fungible tokens, or NFTs in popular parlance. Since 2021, NFTs have gained a lot of media attention, with jaw-dropping headlines of people purchasing them for as high as millions of dollars each. But what are NFTs? Although the name may sound forbidding, the concept itself is easy to understand. An NFT is essentially a digital token that shows ownership of a unique and specific piece of property, hence the term fungible. It can either be physical or digital. The concept really is that simple. Think of it as a digital deed or title over a specific piece of property, be it a home, piece of art, a car, or even a song. For example, the Mona Lisa is a non-fungible item. The one and only original item located in the Louvre in Paris is a unique piece of property and is not interchangeable with other pieces of art. NFTs are different from fungible property, hence the term not fungible, which are not unique pieces of property. Think of a dollar bill or a can of Coke. These items are virtually indistinguishable from other dollar bills or cans of Coke respectively. In other words, there is nothing unique about them, at least in the context of commerce. Cryptocurrencies are fungible as well. One coin or token is indistinguishable from another coin or token, the way a dollar bill is indistinguishable from another dollar bill. NFTs have gained popularity in the past year or two, mainly because of the hype behind digital art. People are scurrying to buy and sell digital art, and the market had ballooned to a whopping $41 billion industry by the end of 2021, and Ethereum is the largest and main conduit to this market. The media is ablaze with stories of people purchasing digital art for millions of dollars apiece. Perhaps the most prominent example of this is when an NFT art piece called Every Days, the first 5,000 days, was sold in March 2021. The piece, which is a collage of digital images captured over 5,000 days, was sold for $69 million to Indian billionaire Metakovan, the same person previously discussed in the introduction. Christie's, the art auction house that was established more than 2 centuries ago in England, auctioned off the art piece, and has reported that it has also seen a surge in overall NFT art sales, and expects such a transformation to open a new era in art history. A bold prediction indeed. Whether such a change to such an extent will occur or not is an open question. Detractors think the NFT digital market is a fad, a bubble that will burst badly like the dot-com bubble in the late 1990s, wrecking the investments of many people. However, the digital art market is still seeing a boom as of January 2022. Even Coinbase, one of the most popular cryptocurrency exchange platforms, is trying to take advantage of this market. In late 2021, it expanded its services to include trading for digital art. For a reputable and well-established exchange to have done this, they must have believed that the future market for NFTs will be very high. While the growth of the digital art means the growth of Ethereum, since Ethereum is the largest platform for NFTs, it is important to point out that NFTs can also be used for many more purposes, and therefore, the potential for growth is massively higher. Imagine if NFTs enter mainstream society in other respects, like to prove ownership of a car or house. That would mean that the current size of the NFT market is only a fraction of what it could potentially burgeon into in the future. If such an expansion were to take place, Ethereum usage and growth would skyrocket. Decentralized Autonomous Organizations, DAOs. NFT artwork and DeFi are the most prominent faces of Ethereum. Decentralized Autonomous Organizations, or DAOs for short, are perhaps the least well-known part of Ethereum, but this could also mean that it has high upside potential adoption. DAOs are essentially digital organizations or cooperatives on the blockchain. Just like real-world organizations, they are diverse and wide-ranging. They can be corporations, not-for-profits, crowdfunding organizations, etc., catering to a wide range of purposes from venture capitalism to charity. Because DAOs are smart contracts, the rules of an organization are already programmed into the code of the organization. Thus, just like other smart contracts, how the organization functions is a self-executing process. It is thus not within any member's discretion to change the rules at will. If anyone wants to change the rules of how an organization works, they must bring it up with the organization as a whole. The other members vote on the proposed rule change. Everyone has an equal vote. If the vote is favorable, a change in the code is made. The same is true when an organization needs to make a decision. A member makes a proposal, a discussion or debate takes place between all members, and then a vote is held. All members have an equal vote. Once a decision has been made, the decision is implemented through code. In this way, DAOs are democratic in spirit and practice, seeking to infuse these ideals in organizations across the world. DAOs seek to eliminate centralized control and hierarchy, like a CEO or board of directors, as found in traditional corporate and political governance structures. Although the space is relatively new, it has already seen a wide range of organizations adopt the Ethereum platform. For example, people of color are using DAOs to share their life experiences and stories. Her Story DAO is an example of this, an art collective showcasing NFT artwork by Black women. There are non-traditional venture capitalist DAOs as well, such as Metacardal, which invest in startup dApps. The point is that DAO growth on the Ethereum platform has the potential to be exponential if people see it as an attractive avenue to establish organizations. If more existing businesses and organizations use it, this area can multiply Ethereum's usage and hence growth manyfold. Chapter 4: Taking it to the next level. Ethereum 2.0. Ethereum is currently implementing a series of large-scale upgrades to its network. These upgrades began in late 2020 and could be completed by the end of 2022. The reason why a separate chapter is dedicated to this specific topic is because Ethereum 2.0 has garnered a lot of attention in crypto videos and news. It's one of the foremost topics being discussed in the crypto community. Not only that, but over time these upgrades may prove to be a significant step forward, not only for Ethereum, but for the cryptocurrency space in general, because of the nature and scale of the upgrades, as will be shown later on. To put the upcoming upgrades into context and understand the importance of them, it's useful to understand some of the problems with the existing network. Transactions are slow, accommodating on average 13 transactions per second, and gas fees are extremely expensive. Gas fees are essentially transaction fees and are calculated according to the computational effort required to carry out transactions. These problems have led to overloads and congestion in the network in the past. Logically, such problems could hinder Ethereum's growth in the long term, as the network would be unable to handle an increasing number of tasks in a quick and efficient manner. Furthermore, it would make some of Ethereum's competitors like Solana and Cardano, which do not seem to have these problems, more enticing. Also, the proof-of-work method that the Bitcoin network currently uses to record transactions in the ledger, refer to Chapter 2 for a refresher, is very similar to the one that the Ethereum network uses as well. It is extremely energy intensive, meaning extremely expensive, and hence damaging to the environment, making the method unattractive and unsustainable in the long term for Ethereum as well. The Bitcoin network, for example, uses more energy than Google and Facebook combined, and more energy than 80% of countries in the world. The worry is, how much more energy would it use in the future as the network continues to expand? Ethereum 2.0 seeks to rectify all the preceding problems by making the network much faster, more efficient, cheaper, and more environmentally friendly. Once the upgrades are fully complete, the network should be able to accommodate approximately 100,000 transactions per second, a gargantuan leap from the current level today. Speeding up transactions to this extent should prevent future overloads and congestions to the network. Furthermore, energy expenditure will drop by more than 99%. This will result in significantly cheaper transaction costs. The next few sections will elaborate on how all these changes will occur. The shift from proof of work to proof of stake. A significant improvement to the Ethereum network is coming in the form of the network's transition from the proof of work method to the proof of stake method, a method that Cardano and Solana, both of which are serious Ethereum rivals, use as well. The proof of work method was already described in the chapter on Ethereum. The proof of stake method is essentially this. All the validators, computers that maintain the network, will be on standby to process transactions. When a new block of transactions needs to be processed, the network will randomly select one of the validators to process the new block. That validator will verify the new block of transactions. To ensure against fraud, the owner of the validator will need to stake Ethereum coins. This means that the owner's coins, which will be greater in value than the total value of all transactions on that specific block, will be put into a kind of temporary seizure or escrow until the transactions have been verified and confirmed to be accurate. The Ethereum website currently states that a validator must provide at least 32 Ethereum coins to stake. Once the network has ensured that the validator has successfully validated a block and has not tampered with any of the transactions in that block, the owner of the validator will regain access to the staked coins. In addition, the reward for processing the transactions will be sent to the validator's owner. The reward for transactions varies and is not constant. It is based on supply and demand. Overall, when a large amount of Ethereum is staked on the network, the amount of the reward decreases. Inversely, when a small amount is staked, the amount of the reward increases. If, however, a validator's owner tampers with transactions, the coins that the validator has temporarily surrendered to the network will not be returned in part or even in full. The proportion seized depends on the amount of fraud. This measure is meant to make it unprofitable to tamper with transactions. It is meant to outweigh the financial harm of tampering with the network over any monetary value a validator's owner may maliciously attempt to seize. If someone still decides to engage in malicious activity, the seized coins will be used as compensation for the value of the transactions. Proof of stake is energy efficient and cheaper. Apart from being more secure, the switch to proof of stake is being made because it is exponentially more energy efficient and cheaper than proof of work. How? As explained in Chapter 2, in the proof of work system, multitudes of computers race against one another to solve complex computational problems to secure a single block. The first computer to solve the problem wins, and the mining reward is sent to the owner of that computer. However, the energy that the many other computers expend is wasted. This is extremely energy intensive and expensive. With the proof of stake method, however, only one validator is responsible for handling an entire block of transactions. No other validator will expend energy for that block. The Ethereum website thus claims that such a system will lead to a 99.9% energy reduction overall in the network, leading to a gigantic reduction in the network's carbon footprint. This significant decrease in energy and resource expenditure would naturally allow for scalability in transactions. Scalability in this context means that the network will be able to direct its efforts to process many more transactions per second, compared with the current proof of work method. Instead of competing against one another for a single block, more validators will be available to process other blocks. That is how, when Ethereum 2.0 goes into full effect, the number of transactions will rise to 100,000 transactions per second. This huge increase will also be aided by Ethereum's sharding plans, which will be explained in the following section. Ethereum 2.0's sharding plan. In an attempt to further increase overall speed and efficiency, the network will go through a sharding process. Sharding in this context means splitting the Ethereum blockchain into different sections, also known as shards. In a way, each shard acts as a separate blockchain. It carries out its own tasks. That way, the burden of the entire network is split up, which should increase the overall speed and efficiency of the network as a whole. Furthermore, the validators for each shard will be responsible for securing transactions in their own respective shards. In December 2020, when the first phase of Ethereum 2.0 was rolled out, the beacon chain was introduced as the first shard. This shard relies on proof of stake but is not open to the public yet. It is still being tested. By the end of 2022 or sometime in 2023, the entire network will transition into shards, each using proof of stake. Chapter 5: The Rising Stars: Solana, Polkadot, and Binance Coin. Even in a short book about cryptocurrencies, it would be unwise to focus solely on Bitcoin and Ethereum. While it would be impossible to discuss every single cryptocurrency out there are many thousands as mentioned in Chapter 1, it is important to at least provide a brief synopsis of a few other prominent projects as well that could become as large as Bitcoin and Ethereum themselves in the distant future. A very bold claim indeed, but no promises, and nothing in this book should be interpreted as financial advice. The currencies that will be discussed in this chapter are Solana, Polkadot, and Binance Coin. Each of these projects offers something unique and will give you an idea of the way that people are harnessing blockchain technology to proffer different, creative digital solutions. The crypto space is indeed a bustling and innovative one. These particular coins have been selected because of their rapid rise in 2020 and 2021, and because they are some of the largest cryptocurrencies after Bitcoin in terms of market capitalization. That does not mean that other projects are not just as promising, or even more. In this sense, the selections in this chapter may be somewhat arbitrary. You may have already heard about these coins on YouTube, but do not really know anything about them beyond their names. Before analyzing each of the above-mentioned coins, an observation will be made. It is evident that smart contract platforms have been on the rise, especially during the past 2 years. Some of these platforms seem to be building off of Ethereum's vision and offering their own unique innovations, while Ethereum in turn seems to be rebuilding itself with Ethereum 2.0, as discussed amply in the previous chapter, to outdo its competition. After Bitcoin, the largest cryptocurrencies by market cap, as of January 2022, are Ethereum, Tether, Solana, Cardano, and Polkadot. All except Tether are smart contract platforms. Even Bitcoin has smart contract capabilities, though this function is not nearly as large as Ethereum's. Apart from Bitcoin and Ethereum, none of these cryptocurrencies were even in the top 5 12 months ago, demonstrating the dramatic rise of smart contract platforms since the market crash in 2020. You can view each of their price charts on coinmarketcap.com to verify this claim. Smart contract platforms are probably the future of cryptocurrencies. So, why are they on the rise as opposed to other cryptocurrencies modeled after Bitcoin, such as Bitcoin Cash or Litecoin? The answer is obvious. Smart contract platforms provide many more practical, real-world use cases compared to platforms like Bitcoin and Litecoin that are mainly or exclusively digital currencies. They offer what Bitcoin offers, an alternative to fiat currency, and significantly more. A brief description of each currency mentioned in this chapter's title will now be provided. It will become immediately apparent that each platform described below essentially offers some sort of improvement or innovation over Ethereum 1.0. Solana. The Solana Foundation, which is based in Switzerland, created the cryptocurrency Solana, ticker symbol SOL. Solana's success has been jaw-dropping thus far, and an analysis of the platform would give a person good reason to speculate that the future is still bright for it. This does not mean that the road ahead will not be bumpy at times. A $1,000 investment in Solana in December 2020 would have grown to roughly $225,000 by November 2021. These calculations can be confirmed through Solana's price action chart. Even by cryptocurrency standards, these are impressive gains and certainly more lucrative than an investment in either Bitcoin or Ethereum during the same time frame. Such investments are of course far riskier as well and much more difficult to predict. So, what is Solana and what does it offer? Similar to Ethereum, Solana is a smart contract platform and already hosts an array of services for both DeFi and NFTs. However, it is much faster, more efficient, cheaper, and more environmentally friendly than Ethereum 1.0. While Ethereum 1.0 can process around 15 transactions per second, Solana can process approximately 65,000 transactions per second, with plans to scale up even more than that. It boasts the fastest payment system in the world, making it faster than even Visa, the second fastest in the world. Solana is much less energy and resource intensive than the current version of Ethereum because it relies on the proof of stake method described in the previous chapter. The benefits of that method have also already been explained in depth in the last chapter on Ethereum 2.0. The network is extremely cheap to use, just a fraction of a cent per transaction, whereas Ethereum 1.0 currently has high gas fees, as already mentioned. So it is easy to understand why Solana has shot up thus far. It is the fastest network in the world and possibly the cheapest one as well. To achieve higher transaction speeds while maintaining extremely low costs, Solana uses, in addition to the proof of stake method, a method called proof of history. This combination is unique to Solana. Essentially, the proof of history method is a way of having a validator, computer on the network, individually timestamp transactions as they are being recorded in the block. So, how does this method further increase Solana's transaction speed? Basically, the nodes on other networks like Bitcoin and Ethereum spend time and energy with each other to figure out the order and time of transactions. To bypass this wasteful chatter between different nodes, a validator on Solana is essentially able to independently and accurately timestamp transactions and process them quickly without the need to communicate with other nodes. The results have been astounding thus far. Solana is fast growing, especially in DeFi. Developers have already built hundreds of dApps in the DeFi space already. Furthermore, their website claims that Solana's DeFi and NFT space is the fastest growing in the world. Billions of dollars have already flowed through these dApps. Due to all of this growth and the overall platform's speed, efficiency, and low transaction costs, Solana has been dubbed as one of the ETH killers, a reference to Ethereum, because some people predict that Solana will eventually overtake Ethereum in market cap in the long term as the #1 platform for smart contracts. The way some people view Ethereum as overtaking Bitcoin one day as the largest cryptocurrency by market cap. However, replacing Ethereum would be a difficult task and would probably take many painstaking years to occur, if it were to do so at all. Ethereum is already significantly more well established than Solana. It is a global leader in smart contracts, the Apple or Google of cryptocurrencies. Overthrowing such a behemoth is a florid claim, easier said than done. Ethereum has many more apps, many times more nodes, and significantly greater commerce on its platform. Moreover, Ethereum is already going ahead with 2.0 upgrades, making the chances for Solana to overtake Ethereum even more difficult. Nevertheless, for the reasons mentioned above, if a cryptocurrency were to overtake Ethereum, Solana would be one of the prime candidates to do so. Polkadot. The Web 3.0 Foundation, based in Switzerland, created the Polkadot project, which is essentially the Polkadot cryptocurrency, ticker symbol DOT, and platform. Polkadot began to trade in 2017. Since then, its price has risen multifold, particularly since 2020. A $1,000 investment in mid-2020 could have grown to approximately $9,000 by mid-2021. Not as great as Solana's explosive movements during the same time frame, but enough to catapult Polkadot to within the top 5 cryptocurrencies by market cap by October 2021. So, what is Polkadot and what is unique about it? Polkadot is a network of blockchains connected to the main chain, called a relay chain. In other words, Polkadot is a whole ecosystem of interconnected blockchains, each chain performing its own tasks, sharing data with other chains in a fast, efficient, and seamless manner. These blockchains are called parachains and parathreads. A project can purchase a parachain on lease for approximately 2 years to gain access to the Polkadot network. Parathreads, on the other hand, are pay-as-you-go blockchains, which are a cheaper option for projects that do not have sufficient capital to lease a whole parachain. Polkadot also has a capacity to connect with external blockchains, such as Ethereum and Bitcoin, through a process called bridging. Bridging allows the connected blockchains to share data with each other. These bridges are mutually beneficial for both Polkadot and for external blockchains. For example, a bridge with Ethereum gives Polkadot users access to ERC20 tokens and Ethereum smart contracts. Polkadot's multi-chain system of blockchains is a significant innovation in the cryptocurrency space. This multi-chain system distributes tasks among interconnected blockchains, thus increasing the speed and efficiency of the Polkadot network as a whole. Other cryptocurrencies, on the other hand, usually function on singular blockchains. For example, Ethereum 1.0 functions on a single blockchain. This is less efficient than Polkadot's system, because all tasks and transactions burden a single Ethereum blockchain. As discussed, this will change for Ethereum with Ethereum 2.0's sharding plans. Polkadot's multi-chain structure is meant to be a transition toward Web 3.0, which is the idea of a decentralized internet, an internet that is run by a network of blockchains, as opposed to through a bunch of central servers. To elaborate, the structure of Web 3.0 is different from the more centralized structures of Web 2.0, which is the current version of the internet and is dominated by tech giants like Google, Microsoft, Facebook, and Apple. Proponents of Web 3.0 criticize Web 2.0 for being too centralized, in the hands of tech giants that collect hordes of personal data and store them in massive servers as large as sports arenas. The problem, they argue, is that the freedom of the individual is compromised in this system. Tech giants not only collect personal data, but also sometimes sell these illegally to third-party entities for a profit, as Facebook has famously done. The human being in this system is a lucrative target, exploited for massive corporate profit, and is continuously bombarded with algorithms designed to keep people addicted to their devices, so that personal data is incessantly collected for perpetual corporate profit. It's a kind of enslavement with all kinds of unsavory repercussions, such as for mental health, for example. Polkadot's mission is to create a new decentralized internet in which the agency of the individual is restored, in which your data is not used as a tool for corporate profit. So, Polkadot can be thought of as striving to be the early beginnings of Web 3.0. Binance Coin. To understand Binance Coin, ticker symbol BNB, it is important to understand Binance. By June 2021, it became the largest cryptocurrency exchange platform in the world, offering approximately 500 different coins for trading. It was founded in 2017 and is currently headquartered in the Cayman Islands. Ever since its inception, Binance has faced legal troubles, first in China, which clamped down on Binance's business activities due to the Chinese government's efforts to tamp down on cryptocurrencies in general, and then eventually in the US and UK, where it has been under investigation due to fraud and embezzlement charges. It is important to note that Binance is different from Binance.us. The latter was established in the US in lieu of the former because of Binance's legal troubles in the US. However, as indicated above, these issues have not prevented Binance's meteoric rise in the cryptocurrency space. As of November 2021, Binance Coin has reached the fourth largest market cap in the cryptocurrency space, and its future seems bright. The network is speedy, having the capability to settle approximately 1.4 million transactions per second. Binance Coin is a native coin for Binance's two blockchains, Binance Chain and Binance Smart Chain. Binance Chain was created in April 2019. To improve the network, Binance then added the second chain, Binance Smart Chain, in 2020. Both chains are interoperable, meaning that they work together in sharing data and information seamlessly, quickly, and efficiently. The reason that the second chain was added was to increase the speed and performance of the network and to improve smart contract functionality. Ethereum contracts can also function on Binance Smart Chain, a key feature and attraction for the upgrade. Binance Coin is also a utility token. This means that you can use the token for a range of special benefits, whether within the Binance ecosystem itself, such as in Binance DEX, or with external partners. For example, Binance Coin users can get cheaper transaction costs in the Binance network, and they can get special access to travel accommodations or get a loan from Binance partners. A prominent feature of Binance Coin is how it tackles inflation. Other cryptocurrencies like Bitcoin have a fixed number of coins in circulation. No one, such as a central bank, can arbitrarily increase this number and thus decrease the value of each Bitcoin. This concept has already been explained in Chapter 2. But Binance goes even further than that. Every quarter, it uses 1/5 of its profits to buy back coins and burn them, which is deleting them from circulation, thus reducing the total number of Binance coins in circulation each quarter. Such reduction of supply naturally increases demand, and hence the value of each Binance coin. So far, Binance has eliminated $649,462,868 worth of coins as of the third quarter of 2021. The goal is to reach down to a total supply of 1 million total coins in circulation, down from the original 2 million coins in 2017. Binance uses a proof-of-stake authority system to validate transactions. This is a combination of proof of stake and proof of authority. Proof of stake has already been explained in the section on Ethereum. Proof of authority is essentially a system whereby only 21 validators are selected from the entire network to confirm blocks of transactions. These 21 validators, updated daily, possess the highest number of Binance coins in the network. The idea is to limit the number of validators on the network. Another way the exchange tries to combat inflation is by rewarding validators in the network with existing Binance coins, not by minting new ones. The fact that Binance has its own coin, which has now become the fourth largest cryptocurrency by market cap, naturally leads one to speculate whether other exchanges like Coinbase and Kraken will eventually create their own coins. If this happens, then will minting digital coins for exchanges be a trend in the future of cryptocurrencies? It is hard to imagine that such will not be the case. Chapter 6: The Wild Ride. The world of meme coins like Dogecoin and Shiba Inu. Meme coins like Dogecoin and Shiba Inu seized media attention, especially in 2021. So, even a short book about cryptocurrencies should explain the hype. The dictionary defines a meme coin as a cryptocurrency inspired by memes and internet jokes. However, some meme coins like Dogecoin and Shiba Inu can also be thought of as cryptocurrencies that investors have a wild craze about. Investors seem to exhibit two main characteristics in relation to these coins. A. Hoarding the coin with the expectation that it will yield a fortune over a short period of time, usually within months or weeks. And B. Fear of missing out on life-changing colossal gains. In short, it is as if some investors are hoping to win the lottery by investing in such coins. Investing in meme coins thus does not seem to be about understanding a coin's fundamentals. In other words, investors do not typically seem to invest in a meme coin because they have analyzed the technology behind it, its potential real-world use cases, hash rate, its long-term potential, etc. It is merely about gauging crowd psychology and getting rich quickly. The thinking is thus strictly short-term. Thus, the phenomena of meme coins is a psychological one, a craze in which many, if not most people, make investment decisions governed by their emotions. A lot of YouTube videos seem to play a pivotal role in inflaming such emotions. For that reason, meme coins are the riskiest investments in cryptocurrencies and can accurately be described as gambling. They are a double-edged sword in that they have created millionaires and even billionaires while crippling many others financially. For example, a person who invested $7,850 in Shiba Inu in 2020 became a billionaire 14 months later in 2021. A simple Google search will yield news stories of other people who have become millionaires through Dogecoin and Shiba Inu in 2021. Shiba Inu's price chart reveals that it was far less than a cent each in 2020. Keeping track of the number of zeros in its price must have been difficult. By November 30th, it was 0.00000000001 cent per coin. By October 2021, almost a year later, it exploded to 0.0001 cent per coin, wiping out 6 zeros in the price. Such an increase was enough to create fortunes for people. Investments in Dogecoin also show massive increases in a short period of time. If you had invested $10,000 in Dogecoin in December 2021, the investment would have grown to $132,758 by May 7th, a gain of nearly $122,000 or 1,300%. Dogecoin received much media attention because of Elon Musk and his tweets throughout 2021, which likely played a significant role in urging the price upward. Eventually, by December 2021, Tesla announced that it would accept Dogecoin on a trial basis for certain Tesla products. The reason that Tesla is doing this, Musk has stated, is because he believes that Dogecoin is a superior cryptocurrency compared to Bitcoin. It is faster and cheaper to use according to Musk. For Musk, unlike for many others, Dogecoin merits support because of its technological potential as a cryptocurrency. As such, the Dogecoin rally may not be over. With Musk's support, in addition to continued support from a community of Dogecoin enthusiasts, Dogecoin could see further sharp increases in prices. It is difficult to keep track of all meme coins, but there are approximately 250 of them, and they share certain characteristics. Almost every meme coin is worth far less than a cent each. Many of them have logos of dogs or are named after dogs. When scanning through meme coins, you get the sense that they are meant to entertain, meant to give you a good laugh. Despite all of this, the rallies in Dogecoin and Shiba Inu give good reason to expect that other rallies, either for these coins or other meme coins, will occur in the future. When or for which meme coin is of course impossible to predict. But as mentioned earlier, crowd sentiment and exuberant emotion is likely to drive prices up rather than actual crypto fundamentals. Chapter 7: Playing It Safe. Stablecoins. Investing in cryptocurrencies like Bitcoin, Ethereum, and even small-cap altcoins can be exciting and nerve-wracking because of drastic price movements in these assets. People can make life-changing gains and even retire, or lose their life savings and fall into depression. The media is full of such stories. However, this same quality of wild price fluctuations is what prevents cryptocurrencies from becoming the primary medium of everyday commerce. For everyday transactions, like buying your groceries or paying for gas, people, consumers, and merchants want a currency that is stable, that is predictable, and that can be relied on to maintain a somewhat constant value over time, just as fiat money does. For example, business owners do not want their revenue to be subject to drastic price fluctuations. Neither do they want their crypto revenues to be wiped out if a sudden flash crash in the crypto markets were to occur. This is where stablecoins come in. Stablecoins are a class of cryptocurrencies as well, but without the wild fluctuations of other cryptocurrencies like Bitcoin and Ethereum. Rather, the value of each stablecoin tracks or is pegged to the value of a stable currency like the US dollar or a commodity like gold. Most stablecoins actually track the US dollar. Thus, stablecoins enjoy the benefits of fiat currency, stability of prices, and the benefits of blockchain technology, rapid transactions, and transfers of money. Why would people purchase or invest in stablecoins? As mentioned earlier, the value of each stablecoin is pegged to a stable external asset, most commonly to the US dollar. For this reason, people are comfortable using stablecoins for digital commerce, such as when trading on DeFi applications, or sending money across borders, or even accessing digital products and services. Stablecoins are thus a popular choice and a rapidly expanding means of commerce. The US government has not failed to notice this either. In a 2021 government report, the government considered stablecoins as an important part of future commerce in the US because of the ease of moving funds around, convenience of using the currencies, and speed of transactions. That is why, as of 2021, the federal government began to explore ways to regulate cryptocurrencies, primarily stablecoins, and to integrate them into America's vast financial system. The government believes that eventually Americans will use stablecoins for everyday purchases, such as for haircuts, groceries, and much more. Another reason why people buy stablecoins is to protect their other crypto investments. For example, if someone anticipates that a crypto investment will suddenly tank, they can convert that investment into stablecoins. When they think that the danger has passed, they can then buy back into that crypto investment again. A simplistic example can help elucidate this point. If a person owns one Bitcoin at $80,000, and that person believes that it will fall by 50% to $40,000, that person can convert that one Bitcoin to stablecoins. If the anticipation were correct, and the price does eventually fall down to $40,000, that person can then convert the stablecoins back into 2 Bitcoins instead of just one. The person would then own 2 Bitcoins, and if the value of Bitcoin again rises to $80,000, well, then that person has made an $80,000 profit and would then own 2 Bitcoins at $80,000 apiece. Once again, this is a simplistic example and depends on timing the market perfectly. But the point still stands that stablecoins can not only help a person to protect their other crypto assets, but also be used to make significant financial gains. Finally, people purchase stablecoins to earn interest. Essentially, you can purchase stablecoins, such as on a popular exchange like Gemini, and lend them out. In exchange, you can earn interest on an annual basis. The next few sections will provide an overview of popular stablecoins to provide familiarity about stablecoins in general. Tether. Tether, ticker symbol USDT, is perhaps the most well-known stablecoin today. The coin's circulation began in 2014. Today, it is the 4th largest cryptocurrency by market cap, behind only Bitcoin, Ethereum, and Binance Coin, and the largest stablecoin by market cap to date in January 2022. Its growth has been exponential ever since the market crash in 2020, when its market cap was roughly $4.5 billion. Now, in January 2022, its market cap is roughly $78 billion, which also indicates the stellar growth of stablecoins in general since 2020. All data can be verified from coinmarketcap.com. So, how does Tether work? The parent company, Tether Holdings Limited, is basically a private bank that issues Tether coins. The company has claimed that a reserve of US dollars or equivalents, which will be explained later, back the supply of Tether coins 1-for-1. In other words, each Tether coin is backed by US dollar or equivalent. What are these equivalents? These are various types of loans, such as commercial paper, certificates of deposit, reverse repo notes, and treasury bills that Tether issues to banks, businesses, and various branches of government in exchange for interest earnings. That is how they make revenue. They loan out most of their cash reserves in order to earn interest. These loans are short-term and purportedly have high ratings, meaning that the loans will almost certainly not be defaulted on. However, the purported ratio of each token being backed up 1-for-1 by US dollar or equivalent has been the subject of controversy for Tether and stablecoins in general. Cynics have alleged that Tether and other stablecoin companies have lied to the public about this ratio. That in fact many Tether coins are in fact not backed at all by any US dollar or equivalent. They are simply issued without any backing, goes a claim. Indeed, there has been truth to these allegations, at least in the past. On October 15, 2021, Tether Holdings Limited was charged $41 million for lying about its reserves from the period of at least June 1st, 2016 to February 25th, 2019. Specifically, not every Tether coin was backed by a US dollar or equivalent during this period. However, Tether has made substantive efforts to assure the public that the ratio does now hold, even if it did not in the past. A report from an independent accounting firm called Moore Cayman, the report is available on Tether's website, assures the public that the 1-for-1 ratio does hold, and it also provides a full breakdown of the reserves, including cash equivalents, and how highly they are rated as well. Still, there are urgent calls for government regulation to ensure that the 1-for-1 ratio holds for Tether and other stablecoin companies as well. In this respect, legislation and regulations seem inevitable as stablecoins and cryptocurrencies continue to grow and become a mainstream part of US commerce. The reason why the 1-for-1 ratio of ensuring that each stablecoin is fully backed by a US dollar or equivalent is critical is to ensure that if there is ever a massive sell-off of stablecoins and investors want their dollars back, Tether and other stablecoin companies can fully compensate all investors with full value. If ever a situation were to occur where stablecoin companies could not do this, due to reserves not fully matching the amount of stablecoins in existence, not only would stablecoin prices crash, which would violate their purpose of having stable prices in the first place, but also many investors would be left empty-handed with worthless stablecoins backed by nothing but thin air. A similar situation of being left empty-handed by banks and money lenders had occurred during the 2008 stock market crash. Money lenders had taken exorbitant loans that they could not pay back to investors during the market sell-off, leaving many investors empty-handed when they came for their money. Not wanting to see a repeat of such a catastrophic situation, the US government is trying to be proactive, seeking to implement rigorous regulations to ensure that reserves fully back all stablecoins and that the loans that are made are not overly risky. DAI. DAI is a unique stablecoin in that it is not backed by US dollar reserves or any other fiat currency. It is issued by MakerDAO, a decentralized organization on the Ethereum network. Please refer to the chapter on Ethereum for more information about DAOs and ERC20 tokens. MakerDAO is also a banking and commerce dApp within which people can borrow, lend, and trade. However, as mentioned already, DAI is not backed by US dollars. Rather, it is backed by other cryptocurrencies, such as Ethereum and any ERC20 tokens. Recall that ERC20 tokens are tokens issued and supported on the Ethereum network. Therefore, those who wish to purchase a stablecoin backed by cryptocurrencies now have that option with DAI. So, how can a person get DAI? The currency can be purchased from an exchange like Coinbase, or a person can deposit Ethereum or any Ethereum-based tokens with MakerDAO to receive newly minted DAI. Another major distinction between DAI and other stablecoins is that DAI is a step toward decentralization, because MakerDAO is not a traditional hierarchical organization like a bank that issues its own policy. MakerDAO, like other DAOs, is non-hierarchical in terms of its organizational structure. Thus, its money supply isn't controlled by a central authority. TrueUSD, ticker symbol TUSD, and PAX, ticker symbol USDP. As mentioned in the section on Tether, stablecoin companies are under intense scrutiny because of the risk that they are issuing coins that are not fully backed, either by commodities or in most cases by US dollars. Meanwhile, the US is preparing to introduce regulations to ensure that reserves fully back all tokens one for one. This section, however, will provide brief descriptions of two stablecoin companies that are taking more concrete steps to prove that their reserves fully back all tokens. The first one is TrueUSD, ticker symbol TUSD. The parent company, Trust Token in San Francisco, publishes independent accounting reports every month that provide a detailed breakdown showing that all tokens are fully backed by US dollars or equivalents. These reports can be found on their website. Furthermore, additional steps are taken to gain public confidence. For example, cash reserves backing tokens are held in escrow in third-party banks, and there are even limitations on Trust Token's ability to access these funds. Such a system hampers Trust Token's ability to suddenly seize the funds and engage in risky lending ventures. The other company taking measures to win public confidence is PAX, ticker symbol USDP. As its website shows, PAX markets itself as the most reliable stablecoin company in the world. The reason is because PAX is regulated by the New York State Department of Financial Services, meaning that it is already compliant with New York State banking laws. PAX's cash reserves and equivalent assets are regularly audited by the state to ensure the 1-for-1 ratio. The steps that TrueUSD and PAX have taken are probably the furthest that any stablecoin companies have taken to win public confidence. Conclusion: the end of the beginning. Speculation about the future of cryptocurrencies is fraught with debate. On the one hand, some have claimed that cryptocurrencies will continue to soar and that the price of Bitcoin will eventually reach $1 million at some point by the end of the decade. On the other hand, others have claimed that Bitcoin and cryptocurrencies are merely a bubble that will explode and that Bitcoin will eventually tank to zero. The spectrum, from the ardent enthusiasts to the naysayers, can be found all over traditional media and online. They include billionaires, millionaires, and YouTubers, fiercely debating the question. Plenty of such debates are available on YouTube. The average person must be thinking, who's right? Predicting the future is obviously impossible. However, certain indicators and trends show that cryptocurrencies are here to stay, that they are the future of commerce and the future of money. How large they will grow and the problems that they will solve are, of course, open questions. Many key factors point to the high likelihood that cryptocurrencies are here to stay. Institutions around the world are investing heavily into them. And when institutions invest, it is usually for the long term. Billions of dollars are flowing into DeFi, which is growing exponentially each year. The NFT market is soaring. Developers have created thousands of dApps that people are already using. To suggest that cryptocurrencies are just a bubble that will explode and they will all fall to zero does not seem realistic at all. Bitcoin has already become legal tender in El Salvador, and polls are showing that many Americans are open to the idea of making Bitcoin legal tender in the United States as well. The same polls show that young people are more receptive to this idea of Bitcoin as legal tender, an indication of Bitcoin's futurity. Apart from the above reasons, it is also logical that cryptocurrencies are here to stay. Even a brief study of them should allow one to conclude that they are a natural progression and innovation within the technological age, a no-brainer in that sense. The technology behind cryptocurrencies is superior compared with ones in traditional financial structures. Payments are significantly faster and more efficient. There is much less of a barrier to entry, and many services can be provided on the blockchain in a decentralized manner, which safeguards your personal identity. This book has merely been a brief introduction to the cryptocurrency space. It should be construed only as familiarizing you with the basics and providing you with a foundational understanding of cryptocurrencies, so that you will not feel completely lost the next time you come across a video or article about cryptocurrencies. In reality, though, there is much more to learn. The study of cryptocurrencies can become a lifelong endeavor, as it has for many people already. The space is too large to cover in a book of this size. Once again, nothing in this book should be construed as financial advice. Be careful, though. Cryptocurrencies are as wild as a capricious lover. You can be over the moon one moment, and you can get really badly wounded the next. Thank you for listening to this audiobook. Leave a review. If you like this book, please leave a review on Amazon or Audible, whichever you purchase the book from. That would be just as nice as receiving Solana coins at $1 a piece back in July 2020.